In this session we'll talk about risk management, trading psychology, measuring trading performance, developing a trading plan, your trading day, session times, and news, rumours, Twitter, and using a Squawk service. There's no trading method that will give you a 100% win rate, and it's an obvious fact that not all supply and demand zones will work, which is why we use good risk management. The two factors involved in risk management are risk-reward ratio and win-loss rate. During this course we'll be discussing some important concepts that will increase both of these. It's been said that trading is 20% strategy and 80% risk management. One thing's for sure, it's the difference between success and failure in this business. Accepting risk means accepting the consequences of a trade or a string of trades without emotional discomfort or fear. This means you have to let a trade setup play out without your mental defense mechanisms kicking in and causing you to close a trade prematurely. In order to do this, you need to manage your risk in such a way that a losing trade or string of losing trades, which is inevitable at some point, will not put your account in an irrecoverable position. So where do you start with applying good risk management principles to your trading account? Firstly, only ever risk a small percentage of your trading account at any one time in the market. 2% is a good starting point, and look to make a larger reward of your profit. To put this into context, imagine that you started trading with £10,000 and lost 50% of that equity. This brings you down to £5,000. It now takes 100% gain or £5,000 profit to bring you back to break even again. A loss of 75% of your account would bring you down to £2,500, and you'd then require a 400% return just to get back to break even. The internet is littered with stories of traders who have blown their accounts time and time again because they broke this golden rule. No matter how certain the trade setup appears, remember the quote from John Maynard Keynes that says, "The market can stay irrational far longer than you can remain solvent." Risk-reward is the only aspect of the market that we as traders can control. It's the ratio of expected profit that we hope to make in relation to our risk as determined by our stop loss. For instance, if the most we can expect to lose from a trade is £100, but the potential profit is £200, the risk-reward is 1 to 2. A good trader will always keep losses small and aim for bigger winners. By keeping trades to a risk-reward ratio of 1 to 2 or higher and passing on the trades that offer lower reward, we can afford to lose 50% of the trades and still make a profit. A classic example of risk-reward is a coin flip exercise. Toss a coin 100 times representing each trade you'll take. I think you'll agree there's a 50% probability of the outcome being heads or tails. Now, if the coin lands on heads, you win £200. If the coin lands on tails, you lose £100, representing a 1 to 2 risk-reward. Add up the profit and loss in this example. We can see that we've made £500. The two important factors in this example are win-loss ratio and risk to reward. Win ratio, or the number of winners to losers that we can expect, is dependent upon our trading system's edge and the skill and experience of the person implementing it. With this coin toss test, the win ratio will be 50%. To ensure making profits, our risk reward would have to be 1 to 2 or greater. In psychology, and this is where most traders trip up. Emotions will play a big part in your trading. You'll find yourself subjected to fear, greed, elation and desperation. As traders, it's these inner demons that we have to confront. It's important to accept that losses are part of trading, a cost of doing business. It's easy to forget that in the heat of the moment, but after a loss, the trader should remain calm and not be desperate to make the money back. On the other hand, another problem that manifests itself in traders of all levels is fear of taking another trade in case they lose again. This can be countered by having confidence in your method, taking a disciplined approach, and back-testing your edge. Struggling traders tend to let losses run in the vain hope the trader will recover, and taking small profits off the table because of fear the trader will go back to zero profit. or even worse, adding to a losing position. The most important word here is discipline. Without it, you are simply gambling at a casino. All trading coaches agree it's critical to keep a trade log. It's one of the most important aspects of improving performance. Actual results are objective and not prone to the psychological biases that interfere with our perception of how we are really doing. At the end of each day, week or month, you should review your trading log. What went well? What could be done better? Feed this back into your plan. So what should you actually log? Well, there's your trade entry, the time you entered, the asset you're trading such as Euro USD, whether you went long or short, your position size and your reasons for entry. And of course on the exits of your trade there'll be similar things. Also note the emotions and feelings during the trade and the type of setup you took, your profit and loss, and the summary and evaluation of how you think the trade went. And also, very importantly, did you stick to your trade plan? On the subject of sticking to your plan, this is a great idea suggested by a well-known trader on Twitter, Tom Dante. When you log your trades, also log the following items. I guarantee that you'll make these mistakes many times while learning to be a good trader, so log them to become aware of them. It will also serve as a safety mechanism to ensure you're not trading on tilt, as we call it. In other words, you're so wrapped up making back your losses, you forget all the rules and ignore your errors. If you repeat the same error a predetermined number of times, then you need to stop trading and reevaluate what you are doing, and trust me, it will happen. So you can see on this chart here that there's various reasons why you could have had a failed trade or a bad trade. So for instance, you exited the trade too soon, or you exited too late, or you entered the trade too soon or too late. Also, a common reason is the trade wasn't actually in your trading plan, or you even hesitated and didn't take the trade that you should have taken. So there's plenty of reasons why you could have had a bad trade or a failed trade or a missed trade, and if you start logging these reasons, then you'll avoid these problems. Developing a trading plan. Whole books have been written on developing trading plans, so let's keep it simple. Take the information in this course and make it your own. Not having a trading plan will lead to random trading, lack of discipline and switching systems. So treat your trading like a business and formulate a plan. Your plan should include things such as strategies that you will trade, your entry and exit methods, which markets and time frames you intend to trade, your stop losses, targets, are you going to scale your trades, the trading times that you'll be working, so New York session or London session, and also when you'll take breaks, because you don't want to end up becoming a zombie and staring at the screen and not knowing what you're doing. Also set yourself realistic daily, weekly and monthly goals and have some key milestones so you can measure your progress. Just like other professions such as software engineering, establish a continuous process of testing, feedback and improvement into your trading. I can't stress how important the gathering of statistics is in this process. It's only by recording statistics that we can develop confidence that a trading method will work. Here's some useful tools for monitoring your trading and making improvements. Jet Screenshot for saving screenshots of charts at the end of each trading day. Evernote's particularly useful for filing away charts in different notebooks. It also has the benefit of being able to sync notebooks across various devices such as tablets and phones. And also Camtasia Studio or some other screen recording software so you can record an entire trading session and then play it back and see what you did in real time. It's very easy to sit in front of the screens all day waiting for a trade. However, this is counterproductive as it leads to tiredness, poor concentration and inevitably losses. Plan your day to ensure you have plenty of breaks. Decide when your most productive time to trade is and block out all distractions during that time. Pick a quiet area of the house, not the kitchen table or the sofa. Shut down Twitter, Facebook and any other distractions. Take the phone off a hook and ensure you are concentrating 100% on the task of trading. This all sounds like common sense, but as home traders we often suffer too many distractions that traders in an office environment wouldn't have. We are pitting our wits against the best traders in the world. It's important to be aware that although many assets run a 24-hour market, local markets across the globe open and close at various times. These affect the ebb and flow of the market. The most active times of a trading session are usually the first 2 hours, and this is often when the biggest moves happen. Conversely, you are likely to be stuck in a trading range for a very long time during inactive sessions such as Asia. Before I start the day, I do a check on upcoming news releases, and this is a habit worth getting into. There are a few places to find this information, but forexfactory.com and fxstreet.com are two of the most popular sites. High impact announcements are marked in red on Forex Factory, medium impact in amber, and low impact in yellow. You should be aware there are risks of holding trades through news, such as slippage. This means your stop loss could be filled at a price worse than you intended. So if in doubt, wait for the dust to settle before entering your trade, but this also comes with a risk of missing the trade completely. Some news items are very volatile and should be sat out. If you're not experienced, namely FOMC, non-farm payrolls and interest rate decisions and key speeches should be avoided. Also be aware that when the market is waiting for a high impact announcement, the market may go into consolidation mode and provide very little opportunity for trading. This is when retail traders often get chopped up. The market is always awash with unfounded rumours, and social media such as Twitter are probably the worst culprits. Plus, there are individual traders' opinions backed up by the most convincing charts you've ever seen. Take it all with a pinch of salt. Using a Squawk service. When a rumour is released, ask yourself what the motive of the person or organisation releasing that rumour is. We receive a rumour at a time chosen by the individual publishing it. This may or may not be the time that the event actually happened. Often, rumours or announcements will occur at supply and demand zones, providing extra confluence to our setups. A Squawk service such as Talking Forex can be very useful for being prompted when a news announcement is imminent or something unplanned happens. As an example, when the Malaysian Airlines jet was downed by a missile in August 2014, the news hit the Squawk before the S&P 500 fell. However, what you will need to do with the Squawk is mentally filter what you hear. This only comes with experience. At this stage of the course, you should know the importance of good risk management and the effects of risk-reward and win-loss ratio on your trading. Understand basic trading psychology and the common emotional traps a trader will face. Know the importance of a trading plan and monitoring performance. Be aware of the news and trading session times. And know the pros and cons of using a Squawk service and social media.